Thank you. So first, let me thank Georgia again for organizing the conference.
Pleasure.
It's always great to be in Brazil, and I know that this year was particularly difficult to organize, so I'm really grateful. So today I'm going to talk about a recent research paper that I finished based on previous research. So the paper is called Loss and Contagion, but actually the talk that I'm going to give is based on results that I got with Quant, and that in fact I presented a bit during the mini course on Saturday, but I see that there is not a lot of significant overlap with the people of the mini course, so I'm going to recall what I presented during the mini course, and I'm going to insist much more on the recent part, so this paper, which is more an empirical application of the theoretical results that we got with Rama. Okay. So if you want to come back to the motivation of this study, the motivation was the observation of realized correlation between asset classes over time. Okay? So for example, in this graph, we see the average pairwise correlation among two indices. So in blue, you have the average pairwise correlation among the S&P 500, and in orange, you have the average pairwise correlation in the Euro Stoxx 50. So what do we do here? In fact, we just look at a fixed window of 250 days, so it's a 1 year correlation. You calculate the correlation between each pair, and you do an average. And so you have a number between -1 and 1. And you do that every day by keeping this fixed window of 250 days. So you have a moving average of the correlation. And so it enables you to see the variations, the dynamics of the correlation. And what we see here is kind of quite remarkable in this year, 2008. And it's the fact that in the beginning of the year, so from January to mid-September, the correlation regime is very stable. You have a correlation on average in the S&P 500 around 35%, around 52% in the Euro Stoxx 50. And then suddenly in mid-September 2008, so exactly after the collapse of Lehman Brothers, you see that those two average correlations spike, right? And what's remarkable is that they spike very quickly, right? It's only 2 months after the collapse of Lehman Brothers. You see that the correlation goes from 35% to almost 50% in the S&P 500, and you have kind of a parallel shift in the Euro Stoxx 50. And so what's suggested here is that, well, you have a normal correlation regime in the beginning of the year 2008, and then something happens in the market, and in an endogenous manner, correlation spike. Okay? So what does it mean in an endogenous manner? It's because correlation at that moment began to be driven not by the fundamentals of the asset, but more by the fact that people started to behave in a systematic manner. And what did people do after the collapse of Lehman Brothers? So mostly people needed cash because they experienced huge losses after those market shocks. And so they deleveraged their portfolio, so they sold a lot of things. And if we look at the prices of equities, so for example in green here, the price of the S&P, of course, you see that the S&P 500 drops very sharply after the collapse of Lehman Brothers, and that this drop is associated not with a liquidity dry up, but with, in fact, more volumes than usual. Okay? So what happens is that in excess of what is happening normally, people sell things because they need cash. And endogenously, this makes those correlations increase. Okay? So, in fact, this is the example of Lehman Brothers, but very often in time, if you look at the history of the failure of large financial institutions or large funds, you witness those correlation spikes which happened very quickly after the liquidation of a large fund. So here I spotted a few examples. I'm going to insist a bit on the last one, which is what we call the Quant crash of August 2007. So this last bullet point, where during the second week of August 2007, surprisingly, all the hedge funds which were equity market neutral, or at least in their denomination, it was written equity market neutral, lost significant amounts every day, so 20% per day. And this was very surprising because the indices at that moment, and typically the S&P 500, So the equity indices did not move significantly. Things were happening in the credit market, but nothing significant in the S&P 500. And so it was quite like an unexpected event, and after the facts, long after the facts, there was a paper by Kandani and Lowe, which is a very interesting paper, which suggested that, in fact, this Quant event was generated by the liquidation of a large market mutual fund. Okay? And when the large market mutual fund sold its position, it affected all the other market mutual funds, okay, which were long short, and so those experienced 20% daily losses, whereas the index, which is not a long short but just long positions, did not move significantly. Okay, and once again, you see that a strategy which used to be profitable, and at that moment, those statistical arbitrage strategies which were market neutral used to be profitable, while those strategies, because of an endogenous fact in the market, collapsed in a few weeks. Okay? And so if we want to think about those effects of correlation, those endogenous losses for funds, we have to come back to the core notion when we study the P&L of a diversified portfolio, and which is at order one, I would say, the correlation between asset returns. Okay, of course, when you want to do things properly, you have to study in a more complete manner the co-movements of all the assets. But let's start by examining what people do with correlation. Well, if we think about correlation, and if you talk to practitioners, well, correlation is one of the key ingredients that a practitioner would use in order to build its portfolio, to do risk management, to do trading allocations, right? And if you speak with those guys, well, they have very complicated models to model the volatility, right? You have so you have constant volatility like Black-Scholes, but you have local volatilities, you have stochastic volatilities, you have volatilities with jumps and everything. But when it comes to correlation, things that practitioners use in practice are much more simpler, right? What do they do to estimate the correlation for taken as an input for building their portfolio? Well, they more or less look at the past realized correlation, right? Maybe they clean it, but they look in the past and then they take that as an input for the future, for correlation. And what does that mean? It means that when they build their portfolio or when they do their risk management, they are going to assume that the correlation structure that they witnessed in the past is going to stay stable. Which of course is wrong, because we see in graphs like that of course correlation regimes change in the market, and they change in an endogenous manner. Okay? Of course, you have more sophisticated models, which are mostly done by academics and not that much used by practitioners, and typically the models by Gurierou, by Martino, Grasselli, Da Fonseca, etc., etc. But once again, if you look at those models, you will see that most of them, the dynamics of the correlation is driven by exogenous factors. So once again, you estimate things in the past, factors, and then you put that as an input, right? And the thing is that when you think about that, well, when you represent correlation in an exogenous manner, well, you're missing something. You have something right, of course. The exogenous correlation can be seen as a correlation in fundamentals, right? But you're missing something, which is the endogenous correlation. Because you see that here you have fundamentals, but that those fundamentals don't matter that much when large endogenous events happen in the market. Okay? And so in the study that I did with Rama and afterwards, the origin of the models that we made was to typically account for those two origins in correlation. A correlation in fundamentals, which is kind of stable, and in the model that I'm going to describe, the correlation in fundamentals will be considered as a constant, okay, for simplicity, and a correlation which stems from trading, okay, and which can modify the correlation in fundamentals, as we saw for Lehman Brothers and lots of other market events. Okay? So what I'm going to do is to present very briefly the framework, the mathematical framework, because I presented it during the mini course, and also I presented it like a few years ago, I think in Rio. But more interestingly, I think, and in a more practical manner, I'm going to develop the econometric tools that you can build from those models, and which will enable to investigate in a systematic manner the abnormal regimes of correlation. Okay? The idea behind that is that when you see things like that, correlation regimes change, well, you have information there. Okay? You know that things are happening. Okay? So we're going to use this dynamics of the correlation to infer some information about what's happening in the market. Okay? So the model that I used, so briefly described, is the following. You have n assets, right? And the assets, so you take, for example, a continuous time market, and the fundamentals, for example, in n dimension, is like a multi-dimensional Black-Scholes with a constant covariance matrix sigma. Okay? So the fundamentals are kind of Black-Scholes. Okay? You can input whatever you want, but let's start with something simple. But then on top of that, you add some funds which are trading in the market. Okay? So what do we assume for those funds? We assume that they hold initial holdings, right? Alpha ij is the number of shares of asset I held by fund j. And so the value of the fund j at day t is this sum, right? And what we know is that when a fund experiences too large losses, well, it will need cash for a reason or another that I'm going to describe in a few slides. And how do funds get cash? They sell some of their assets. Okay? So why do funds need cash? Well, typically for capital ratio constraints, right? If you look at what is imposed by the regulators, and we were discussing that with Nicole yesterday, the regulator will say, okay, if your leverage ratio goes below 3%, you have to bring it back above. If your risk-weighted ratio goes below 8%, you have to bring it back above, et cetera, et cetera. Okay? But how do you bring back a leverage ratio above a certain threshold? If you think about the leverage ratio, it's a ratio between equity and size of assets. So if you want to make that increase, either you increase the numerator, so raise equity, but this, usually you don't do that when you are in a period of shocks in the market. You don't raise equity because it dilutes the previous investors, and also raising equity during a period of distress is very costly. So what you do to raise capital ratio is that you decrease the denominator, so you diminish the size of your portfolio. Okay? So in an endogenous manner, even if you don't want it, because the regulator imposed a rule for you, you're going to have to liquidate. Okay? There are other reasons why you should liquidate. Imagine that I'm a fund manager and I manage money for my clients, and I experience a large shock. Okay? Well, very often what's going to happen is that some of my clients are going to come to me and say, okay, you're a fund manager, we trusted you with our money, but now I see that I lost a lot of money by giving you some cash. So what are they going to do? Some of them are going to run for the exit, so take their cash out of the fund. So what do I do when one of my clients asks me the cash back? Well, if I have cash, I give the cash, but usually I don't have cash because I invest for my client. So what do? I liquidate a part of my portfolio and I give the cash back. Okay? There are other reasons, lots of reasons to liquidate portfolios in a systematic manner. You had, for example, in 1987 during the Black Monday, this what we call the portfolio insurance strategy, which accelerated market declines. You have sales of assets which are held as collateral and which are sold in a systematic manner when someone defaults. But you see that in real financial markets, in practice, when you have a negative shock, which is large enough, okay, because of one of those reasons, or because, for example, your VAR spikes or things like that, you're going to be led to liquidate a part of your portfolio. Okay? So what we assume here is that, well, you liquidate this portfolio in a proportional manner. Okay? So this is an assumption, but you can do whatever you want, right? And in the model, you can compute whatever kind of liquidation strategy you have. And of course, what happens is that when you're a large fund and you liquidate your positions, well, you have an impact. Okay? And especially if you're a very large fund, or even if you are a lot of small investors. Okay? And typically, The worst is when a lot of large funds liquidate their positions at the same moment. So how do we measure the impact of this liquidation? So first we call this gamma Tj the instantaneous rate of liquidation by fund J at day t. So most of the time, this gamma Tj is equal to 0. So it means that almost always there are no liquidations. Okay? But when the prices or the fund values decrease too much, this gamma Tj in the model are going to be strictly positive. So you're going to liquidate strictly positive values. Okay? And so we're going to assume that this liquidation impacts each asset in a proportional manner. Okay? So we take a very simple linear price impact. And how do we model linear price impact? We introduce, so something actually that Sebastian talked a bit about during his mini course. We introduced the market depth for the asset, which is DI, and which is like a linear measure of the liquidity of the asset. So the larger the DI, the more liquid the asset. Okay? So typically, an asset which is infinitely liquid will have a DI which is infinite. And so it means that whatever you trade for this asset, you're not going to make the price of the asset move. But of course, in practice, all assets have finite liquidity, because if you liquidate a large enough number of assets compared to the depth, you're going to make the price move. Okay, so we capture that in a very simple manner with a linear price impact model. Okay, so of course those are just the ingredients of the model, but the mathematics are done in a very rigorous manner, and I insist on that because I'm at IMPA, and we love mathematics here, right? Yeah, exactly. The temple of rigor. That's a very nice thing. And so what we end up in terms of correlations in a rigorous manner, right, is this kind of figure. In the continuous time limit of this model, which is in fact taken in the beginning in discrete time as a Markov chain, okay? In the continuous time limit, you have the realized correlation matrix that you can also think of as the multidimensional covariation matrix, right? It's equal to the fundamental covariance matrix, sigma, plus all those terms in red here. Okay? And what are those terms in red? Those terms in red are terms which are endogenously generated by fund liquidations. Okay? So, of course, those terms in red, when the gamma, which is the rate of liquidation, when this rate of liquidation is equal to 0, well, of course, those terms disappear, right? So when you have no liquidation, of course, the realized covariance is more or less the fundamental covariance. Okay? Markets behave in a fundamental manner. Okay? However, also, when you have infinite liquidity, so market depth which are infinite DI, well, this vector capital lambda, which is a vector of liquidity, of the inverse of liquidity, this vector lambda goes to 0, and also when you have infinite liquidity, the covariances that you see realized in the market are close to the fundamental covariance. Okay? However, as soon as you are liquidating assets which are not infinitely liquid, okay? So it means as soon as you are liquidating positions which are large enough compared to the liquidity of the asset, you're going to make the realized covariance differ from the fundamental covariance. Okay? And that's typically what happens here, right? What happens here is that you have a fundamental regime for the market, and then people here liquidate. Okay? And so those terms of addition are typically the terms in red in my equation. Okay? Which are here. Okay? And so what we end up with is something which is a little bit more realistic, is that the realized covariance that you observe is equal to something which is kind of a fundamental covariance, like a stable relationship between the assets, plus something which is path dependent and liquidity dependent. Okay? Of course, when people are going to liquidate large number of assets, they're going to make the fundamentals modified, okay? Or they're going to make the realized covariances differ from the past fundamentals. Okay? And so what's nice is that all the impact here are computable, right? So you can take that as an input for trading management system and have an endogenous, representation of your losses. Okay? So I'm not going to talk too much about that. I'm going to now do some econometrics, or at least estimation of the models, of the model parameters. Okay? So if you want to sum up a bit the model works in the following way. If, in terms of realized covariances, if there are no fire sales, okay, the realized covariance C is equal to the fundamental covariance. Okay? But if there are fire sales, the realized covariance is equal to the fundamental covariance plus terms of correction, which are generated by people liquidating a portfolio. Okay? And if we look at the form of this correction, well, in fact, it's so at order 1 in liquidity, right? We see that the form of this correction is quite nice because it's something which is the product of a L, which is a matrix of liquidity, which can be estimated in the market in a way or another, pi, which is a matrix of prices, sigma, which is the fundamental covariance matrix, which can be estimated theoretically during a period without fire sales, and this matrix M0, which is a matrix which contains all the information about the liquidations. Okay? So in fact, if we look at that, if you know this matrix M0, you know exactly how the positions which were liquidated and which caused the change of covariances. Okay? So now the problem is the inverse problem. What we observe in financial markets is that correlation spike, right? Correlation spike in an endogenous manner because people are behaving in a systematic manner during periods of stress, okay? And what we want to do now is to use this model and say, okay, according to my model, of course, correlation spike, okay? But can I estimate the models of my parameter which explain this spike, okay? So mathematically, what does that mean? It would mean, can we invert, if we are given C, sigma, L, and pi, can we find this matrix M0? Okay? And when we find this matrix M0, you have the information about the liquidations, right? Right. So, in fact, the problem can be resolved quite easily. It's just a linear algebra problem. And you can find this matrix that I denoted phi, which is corresponding to the M here. Okay? And so you can investigate the liquidation episodes, right? So in terms of econometrics, it's not that simple because to estimate this matrix of liquidation, you need L, which is a matrix of liquidity, and let's say that it is estimated in a correct manner, but even that is not sure, right? Pi is a matrix of prices, so this you know, but you need to know the realized covariance C and the fundamental covariance sigma. Okay? And what you have in financial markets are only estimators of that. Okay? You never know exactly the realized covariance, like the real realized covariance. You know empirical covariances, and you never know the fundamental covariance. You know estimates of the fundamental covariance. Okay? So for example, if you estimate fundamental covariances and realized covariances by using asset returns at intervals tau, you have an estimate which depends on this tau, right? So there's a bit of econometrics here to see that the estimator that we have depends on those estimator of sigma and C, realized covariances and fundamental covariances, but we show that in fact the estimator is consistent and we derive a central limit theorem. Okay? All right. So the thing now which is interesting is the following. Assume that you know things like that happened. Okay? Now, what we do with this model is to say, okay, this happened. Okay? What are the positions which were liquidated and which caused this increase? Okay? And this would just mean that we just calibrate the model to that. Okay? If we do that on the S&P 500, among the 9 sectors of the S&P 500, we find something which looks like that. So you have here 9 sectors of the S&P 500, and this is the weight of each sector according to our model, which was liquidated and which caused the correlation spike of the previous slide. Okay? And you see, of course, that our model weights, gives the higher weight to the financials, okay? And then the energy stocks, which are here, and then all the others have more or less equal weights. Okay? So you have a way with this kind of models to investigate after the fact, right, a past abnormal regime of correlation. Okay? And you say, okay, now this happened. According to my model, it is these positions which caused this to happen like that. Okay? And it is those positions which were liquidated which caused those correlation spikes. Okay? All right. So, in fact, the thing that I propose like that is only useful after the fact, right? So now we want to have something a bit more dynamic, right? Because after the facts, everyone knows that something happened, right? So let's try to build something which is a bit more dynamic. If we think about the case of Lehman Brothers, everyone more or less knows what happened. There was a shock of Lehman Brothers' failure, and people needed cash because their VAR increased, so they sold their assets, or they needed cash because they didn't have enough capital compared to the ratio that they should have, et cetera, et cetera. Okay? But there are more complex events, such as the one of August 2007, where people don't really know what happens. Okay? In August 2007, during this week where all the funds, the hedge funds lost a lot of money, no one noticed that. It's only a few months later when the hedge funds published their results that the data providers said, okay, there's something weird which happened. All the hedge funds, equity market neutral, gave their P&L, and just for this week, it's all negative. And this is what motivated the work of Andrew Lo on this topic. Okay? So now, let's do the following thing. In the model, what you can estimate is, given a period T minus WS, or WS for window size, and T, with possible fire sales, and given a period of time step before, without fire sales, you can estimate theoretical magnitude of fire sales, okay, which caused the covariances to move. Okay? So it means that if you look at covariances here, and you compare them to covariances in this interval, and you apply the algorithm, you can estimate as a function, as a ratio of market depth, you can estimate the liquidated portfolio, right? So what's interesting is the following thing. Here, you have the liquidated portfolio on each asset, okay? What's important is not the sum of those, but the sum of the absolute values, okay? Because it means that you liquidated longs and shorts, and it gives you a magnitude of the whole thing, okay? So what we are doing now is doing the following thing. Every day, okay, we are comparing the 1-year realized covariance matrix of today to the 1-year realized covariance matrix of 1 month ago, okay? And we're saying that today we're looking at the realized covariance matrix, and the one of 1 month ago plays more or less the role of the fundamental covariance matrix, okay? And we say that between last month and today, we are going to assume that covariances moved because of systematic events in the market. It can be fire sales, but in fact, it can be any type of stress, okay? But we then apply the algorithm, okay? And the algorithm says the following thing. Comparing the two covariance matrices, okay, if the movement that you observe in covariance matrices is explained by fire sales, the magnitude of those fire sales should just be this sum. Okay? And you do that every day. Okay? So every day, you compare the 1-year realized covariance matrix with the 1-year realized covariance matrix the month before, and you estimate potential magnitude for fire sales which caused this movement of covariances. Okay? And then you do that every day. Okay? Of course, when I tell you that the assumption is that the movement of covariances is due to fire sales, of course, it's a very strong assumption. But in fact, you don't really need this assumption. You just observe movements of covariances and you estimate your model like that, right? And what happens is that if the movement of covariances is significant enough, this algorithm will give you a liquidation index, so the leaks, which will be large enough, okay? So this leaks, liquidation index, captures the jumps in covariances, okay? Not just looking at if covariances increase, but calibrating a more complicated model that I presented, okay? So it's not just capturing jumps in covariances, it's a joint movement of decreasing prices and jumps in covariances, okay? And so if we look at the evolution of the leaks for the S&P 500, what do we see? We see something like that. From 2000 to mid-2014, so around 15 years of data, 14 years of data. Well, you see that this thing here is almost always equal to 0, right? And what does that mean? It just means that when you compare today's covariance matrix with the one month ago, well, they're very close, right? So the algorithm says that they didn't move that much, so there was not significant liquidation which caused this move, because it was very small move, okay? And so this is why it's very small here, okay? However, you see very remarkable spikes of this liquidation index, right? If you look here, the largest spike, when does that happen? Of course, it happens just after the collapse of Lehman Brothers, okay? So the liquidation index here spikes very sharply after the collapse of Lehman Brothers, because it says it detects a huge co-movement between covariances and prices, and which generates this spike. And in fact, you see that it generates much more than just Lehman Brothers. It starts to spike from mid-2007, which is in fact the onset of the subprime crisis, okay? And if we look here at the first spike, and we're gonna come back to that afterwards, it's the Quant event that I just discussed before, and which is kind of the beginning of the contagion effects of the credit market on the equity market, okay? If you look at the other spikes, here this one is the downgrading of the US, okay, which happened also recently, so mid-2011. Here you have the spike linked to the internet bubble. You have also the spike here in September 2001 after the terrorist attacks, okay, which generated a huge decrease of the index. So you see that, in fact, calibrating the model enables to build this liquidation index, which can be viewed as reflecting the stress of the equity market, right? And it's, if we want to compare this stress, this measure of stress of the equity market to the regular measure that we use for the stress of equity market, what's the regular measure? It's what we call the VIX, which is the implied volatility of the S&P 500. If we put them in the same graph, so on two different scales, right, you see that they're very much linked, right, because the stress in the leaks is positively correlated with the VIX, right, and you see that when the leaks spikes, it corresponds to spikes of the VIX. But what's nicer, much nicer, is that it has very low autocorrelation, okay? When you have a spike in the equity market, the VIX, the implied volatility, spikes, and then it stays high very long, right? Okay? But in fact, in the market, there are no more liquidation phenomena. When you look at what happened after Lehman Brothers, you have this shock in mid-September, and then you have 2, 3, 4 months of intense liquidations. But this period corresponds to a market which went up, right? But still, the VIX is still very high here, okay? What we don't have here with the liquidation index, which spikes back at very low levels when it detects that covariance regimes just normalize the gain, okay? And if we want to zoom a bit on certain events, okay? Well, we see this thing. So if we zoom on Lehman Brothers, here in red you have the date of the collapse of Lehman Brothers, and you have in blue the evolution of this index that I just built. And of course, you see that it doesn't anticipate at all the collapse of Lehman Brothers, right? And once again, I'm never saying that the index that I'm building is supposed to anticipate things, okay? It can never be used in a systematic manner to anticipate because it uses realized covariances. So very naturally, it's backward looking, right? Okay. But still, we have something which is kind of contemporaneous, right? And not too far away. If we look at something else, the Quant event, which is the week of August 2007 where those hedge funds liquidated their positions, well, here you see something which is much more interesting. You see that here it's the week where the Quant event began in August 2007, and you see that the jump of the leaks, the liquidation index, anticipates this time this liquidation. Okay? So here you have kind of a signal here. Okay? So it's, once again, it's not something to trade, it's not something to make money on, but it's something to monitor, right? When you have a signal like that, and you see in the beginning of August, before the second week where the liquidation started, you see values like this one for the leaks, you know that something unusual is happening, okay? Doesn't mean necessarily that it's going to crash or anything, right? But you have a signal, and this is important. Regulators and risk managers need to have signals. You never know if a crash is going to happen for sure, but what you need is a signal which says, okay, maybe there's a slightly higher probability or a significantly higher probability that this is going to happen, okay? And this is typically what's done here, okay? So it doesn't work here, okay? But for Lehman Brothers, is that interesting? Everyone knows what happens after Lehman Brothers. But for more complicated events, it works not that bad, okay? And if we want to think a bit about the leaks in terms of behavior, you see that all those very small values which are associated, which are given by the leaks, they reflect kind of a fundamental behavior, right? When the leaks is very small, very low, it just means that markets are behaving like kind of in a normal manner, right? And when there are spikes, it means that there's something wrong happening in the market, okay? So once again, you can use that as a regulator to anticipate, or not even anticipate, but monitor, right? But you can also think in terms of risk management or in terms of trading. In terms of trading, what do you do when you build a portfolio? Very often, you build a portfolio saying, okay, I'm going to estimate my correlations, my volatilities, and I'm going to build something which is kind of optimal, right? But those portfolios, when are they efficient? Like efficient? They're efficient when things are behaving normally, right? They're completely sub-efficient when there's a crisis, right? Okay? So what we can do here is try to build a portfolio, okay? In times when the liquidation index is small, and then just adapt the portfolio when it's high, okay? So the basic thing that I'm going to show you is the following strategy. You are long the S&P 500 when the leaks is small, and when the leaks jumps above a certain threshold, okay, I think it's some kind of a function of the median, you just become neutral to the S&P, okay? So you have position 1 on the S&P 500 when the leaks is small, and position 0 when it's high, okay? So it means that you just go out of the market when you detect distress, right? That's all, that's just that. And when you do that, you have the following graph, okay? So in red, you have the S&P 500, and in blue, you have the strategy with the liquidation index. So adjusted, which means that as soon as you detect something unusual happening in the market, you just get out of the S&P and say, okay, I don't want even to trade the S&P, I'm just getting out of the S&P 500 because my system detects something abnormal. And you see that in terms of performance, but also in terms of Sharpe ratio, so in terms of Sharpe ratio, actually it doubles the Sharpe ratio, but let's not talk too much about what significance to give to Sharpe ratios because they don't reflect that much things. But even in terms of performance, you see that, okay? All right. So actually, there's a graph that I could not put here, but I did the same thing for the Brazilian index, right? And I discussed that with George. And so I have the graph for the Brazilian index and the French index. And in fact, so of course, you have the same kind of jumps, right? So you have the jumps in Lehman Brothers. You have also jumps after the downgrading of the US, because in fact it had huge contagion effects. But what's very surprising for the Brazilian index, I remember that there was a very weird jump in 2012, I think, in the end of the year 2012. And when I discussed a bit about, with George, he explained that this corresponded to the beginning of the trial for the Mensalão scandal, or something like that, right? Okay. And in fact, what's interesting is that, so not only does this kind of index detect like large macro shocks, right? But when you do that on a particular country, it also detects the particularities of this country. And so I was very surprised because I didn't understand, and I thought, well, this is just a wrong signal, right? But that's not bad for a regulator. Wrong signal just means, okay, you were too cautious, but it's never bad to be too cautious, right? But in fact, for the Brazilian index, it was like a spike which followed the Mensalão scandal.
The numbers don't lie.
Yes, exactly, especially in Brazil. Except if they're given by politicians. All right, so I'm going to conclude. I'm going to conclude by just saying that, so the framework that I used, so basically the model that I use is kind of simple basis model, which is adjusted for liquidity, right? And that's all. And it captures the large liquidity moves in the market. And in fact, we see that, well, of course you have, so you have econometrics theory behind that, but what's important when you want to put that in practice for a regulator or risk manager or something like that is that you have kind of nice graphs which are easy to interpret like that, okay? And you can just compare how it behaves like with other indicators like that, okay? So some things that could be done to improve a bit those kinds of things, or at least give maybe other types of signals which are not only backward-looking, but also forward-looking, would be to use, instead of as inputs realized covariances, use implied covariances, okay, which is kind of a complicated problem, because how do you measure implied covariances in a market? Okay, Carol gave a very nice talk last year about that. And so those are ideas for future research. Also, I developed, and I'm just going to conclude there, I developed this kind of signal in a very more trading-oriented manner. So I did that last year in Knight Capital in New York. I was there for 5 months, and I developed that. What's the idea? And it works quite well. What's the idea? The idea is that the algorithm that I propose says that, well, you detect a movement, a shift of covariances which is too large and which signals something's happening, right? And it also says that if you could interpret this shift of covariances or shift of correlations by a liquidated portfolio, well, you know the direction of the liquidated portfolio, okay? So the kind of strategy that I implemented was to build this signal at a high frequency, right, higher frequency, and say, okay, if I detect something, okay, I know the portfolio, then I'm going to bet on the mean reversion of the portfolio, okay? Because it was liquidated, but at one point fundamentals come back, right? So maybe not for Lehman Brothers, but for small events in the market, they come back. And actually by doing that, you have kind of a nice trading strategy that you can implement daily, looking at intraday prices and how they got modified over the last month. Okay? All right, so those are the papers that this talk are based on. So most of the talk is based on this paper, Lost in Contagion, but for those who are interested in the math, they are given in those papers. Okay? So thank you very much.
Thank you. And